Greetings, I am moderator Megan Trillette. Welcome to our webinar featuring Dr. Thomas Ho and Professor Moorad Choudhry on principles and income risk to avert Silicon Valley bank-type collapses. Our presenter, Dr. Thomas Ho, is the founder of Thomas Ho Company, a New York-based financial technology company, consultant to major financial institutions, including AIG from 1999 to 2005. He designed the global risk management system, ALM processes for the life companies, and risk monitoring for derivatives. When Tom founded Global Advanced Technology, GAT, in 1987, he developed cutting-edge technology for delivering innovative solutions to 250 major global institutional clients. Out of the top 10 largest life insurance companies then, 9 of them were GAT clients. Tom is the author of more than 80 publications, including Holy Model, co-creator, and the co-developer of the first arbitrage-free stochastic interest rate model, widely used in capital markets and asset liability management used by all financial institutions. Our other presenter, Professor Moorad Choudhry, is a non-executive director with 2 UK financial institutions and was latterly treasurer of the corporate banking division at the Royal Bank of Scotland. During his career, Moorad has been chair of the Asset-Liability Committee at different banks from 2003 to 2014. Both presenters are authors of the following books: The Principles of Banking and the Oxford Guide to Financial Modeling. These 800-page books cover comprehensively banking and modeling. These books will provide the context of the subject matter of today's webinar. We will have the Q&A open for any questions or comments that you might have during and after the webinar, which I will guide you through. Feel free to ask any questions at any time, and I will direct them to our presenters. Now I will pass this over to Dr. Thomas Ho and Professor Moorad Choudhry.
Moorad.
Thank you very much. Thank you very much, Megan, for the introduction. And may I just say what an honor it is for me to be presenting this webinar with Dr. Ho. I can't imagine it. I just can't imagine it. Megan, you just mentioned Dr. Ho's authorship of the Holy Model, 1986. I was reading about that when I was on the prop desk at Hambros Bank in 1997 in Professor John Hull's book. And here I am, nearly 30 years later, presenting with him. This is just fantastic. Okay, so we're going to talk, first of all, thank you. My pleasure to be here, and good afternoon, good morning to you all around the world. I'm going to spend the next 20 odd minutes, 20, 25 minutes talking about what I call strategic asset liability management, or as we see here on the slides, proactive bank asset liability management, which for me has become an imperative for banks in the post-Basel III environment, whereby we have much more greater constraints on capital and liquidity, as well as a higher cost associated with those two balance sheet items, as well as the needs and the requirements of other stakeholders, including, of course, the regulatory authorities and our customers. Challenges for us, forgive me, Tom, just a bit too premature there on the slide, if we go back one. The challenges for us are we optimizing our ALM approach? In other words, have we moved from a reactive approach to managing asset liability risk or discipline in a bank to a more proactive one, which means are we considering an even-handed approach to maximizing net interest income as well as understanding balance sheet risks? And hopefully we take away from the webinar today, in both halves of this webinar, an understanding of what proactive balance sheet management means, and of course a greater understanding and an ability to avoid Silicon Valley bank type scenarios, i.e. understanding the exposure of our balance sheet to changes in external market factors, particularly interest rates and foreign exchange rates. Thank you. So what does strategic ALM refer to? As I just introduced now, we have essentially 3 types of stakeholders. The original stakeholder, of course, is the shareholder, the owners of the bank, who are always interested in maximizing return on capital. But we also have the requirements and the needs of 2 other, what I'm going to call stakeholders, which of course are the regulatory authorities and the customer. The shareholder, of course, likes products or a balance sheet structure that maximizes return on capital. So ideally, there would be the cheapest source of funding and the highest returning within credit risk appetite, the highest returning source of lending. The regulator likes a stable, robustly structured balance sheet for both capital and liquidity, and customers, of course, like products that are useful to them. So if you look at that Venn diagram, very simply stated, right in the middle, a product that would meet the needs of all three would be, for example, a checking account, which has low cost for the shareholder, has stable funding characteristics for the regulator, and is, of course, a product that customers will always need and will want to have. So if we think about the product mix on a balance sheet, if I'm bringing a strategic ALM, a proactive ALM focus to planning and volume setting over a medium-term target horizon, I would want to maximize those products that sat in the middle, and then see what the most optimum mix was for those products that sat outside that sweet spot in the middle. And really, we're only going to achieve that if the asset liability committee in a bank actually brings this focus to the planning, the budget setting cycle. Because traditionally, when one sets, in my experience, my observation, when one is setting the next 12 months or the next 3 years volumes for the business units, it's done on a bilateral hub and spoke basis between the finance department and the business lines. And each business line concentrates on maximizing its product origination. But of course, that might not necessarily result in an optimized balance sheet structure. So the ALCO ideally oversees a process whereby the needs of the asset liability management function, optimizing the balance sheet structure and the product mix, also influence volumes and target setting. Okay, thank you. So that brings us a bit of a challenge, doesn't it? I just mentioned, for example, the traditional approach to volume setting when we put in the budget for the next 12 months or the next 3 years in a rolling corporate plan. We have got communication challenges, and I would like to think that the Asset Liability Committee is the right place to oversee and meet those communication challenges, because we have, of course, the balance sheet management function, treasury and finance. We've got the second line defense, risk, and we've got the business units. Okay, and if you look at this diagram, the source is Claude Shannon. He applied his research approach to the challenges that one would observe in banking, which there's a nice illustration there on that slide about how we've got external market risks from the capital markets. We've got the reporting of that. We've got the assessment of that risk exposure, the evaluate side, and then we've got to then assess what that means as we go forward to quantify the risk exposure and then manage that risk exposure to within our appetite. Okay, and if you look at the last line there on slide 5, that requires a really good data analytics approach. We need to understand what our risk reports are telling us. They've got to be accurate and up to the minute, ideally real time. And then we take that understanding and make decisions based on current exposure, but also we want our forward-looking exposure to look like. And that's a real communication challenge. And if you think about, again, how banks and indeed most corporate entities are organized, they have a bilateral approach. They have almost a siloed approach. You've got the center, the finance function and the CEO's office, and then you've got the siloed business unit. And that brings a communication challenge. Again, I reiterate, the place to have these conversations to address this challenge would be in the Asset Liability Committee. Okay, next slide, please. So principle number 1, when we look at the principles involved in moving to a proactive ALM process, a proactive balance sheet management process. Principle number 1, quantification of risk. We need to understand our risk exposure, both currently and what we expect it to be under various different circumstances or market conditions in the future. And when I say future, I do mean beyond the immediate short term. Ideally, we'd have at least a 12-month lens for looking at risk exposure under different scenarios from today, and the exposure to different types of risks, and also our sensitivity of our balance sheet to changes in these risk measures. So one might undertake that through simulating income under various scenarios. The regulator requires us to apply capital and liquidity stress tests, the much vaunted ICAP and ILAP processes, and we want to understand the sensitivities of our balance sheet to changes in external factors. Now, the risk management process, as I mentioned, is reactive traditionally, because the business units which generate the risk when they undertake customer business, lending money or taking in deposits, aren't the ones that on an aggregate basis for the whole balance sheet, manage this risk on an ongoing basis. That's undertaken by Treasury and Finance, and then with a second line oversight of the risk unit. Okay, so this brings together a whole host of challenges when we look to quantify risk. Okay, interest rate risk exposure, the credit risk models that we're using, how are we measuring liquidity risk, and within that, a subset of both liquidity and interest rate risk, how are we modeling the behavioral profile, the tenor profile of our non-maturing products, non-maturing deposits, NMDs, and of course, non-maturing assets such as overdrafts. Okay, ideally, the information output I would like back from the simulations and the stress tests and the daily risk dashboard would be a sufficient level of granularity down to product and customer and currency levels to enable me to understand granular level detail as well as aggregate level detail. Okay, thank you. So for an example, let's look at IRRBB. Now, this slide actually takes data from an ECB report from many years ago, which is based on the Basel Committee's, the Bank for International Settlements, the Basel Committee's guidance on interest rate risk in the banking book. Now, because of this guidance, which has been applied in varying levels around the world, in some countries, such as in the UK or in the Eurozone, the Basel guidance has been adopted more or less word for word and applies to every bank in that jurisdiction, whereas in some other countries, it applies only to, say, for example, designated systemically important banks. But be that as it may, in the IRRBB guidance, we have two different metrics, and they are conceptually different. We have the earning sensitivity measure, net interest income, or the delta of the net interest income, and we have the what I call present value sensitivity measure, what the Basel Committee called economic value of equity. That's, in essence, the net present value of the balance sheet today. We want to understand the sensitivity of those two metrics, which are conceptually different. The calculation is different, although it's a straightforward calculation, they are different conceptually. We want to understand what those two metric numbers are for today. And in the case of earnings, net interest income, it's a forward-looking 12-month or at least 12-month metric. And for EVE, it's a current snapshot number. We want to understand what that value is today, but we also want to understand what the value was likely to change by under certain interest rate scenarios. That's an example of the challenge associated with risk quantification. We have two different metrics. We want to understand what they are today, and we also want to understand what they are likely to look like, or what they will change by under different interest rate scenarios. So straight away, there is a data analytics challenge there for us, which the ALCO wants to be on top of. Okay, thank you. And slide 8 is basically giving you a bit more detail. I'm making an assumption that everyone on the seminar today, on this webinar today, will have received these slides, or will receive these slides. So slide 8 is simply summarizing what I just mentioned now. Two different metrics for managing interest rate risk in the banking book, so non-traded interest rate risk. We want to understand how changes in rates will impact both the earnings of the bank as well as the current value, the present value of the balance sheet. Two different metrics, two different calculations. We want to make sure, ALCO wants to make sure it's got the assessment of that sensitivity under different rate scenarios today with a forward-looking view, so that it can take critical decisions on how the balance sheet should be structured. If we think about that, theoretically, it's quite a simple conversation. You know, if under a certain scenario, earnings will drop and the EVE will go up, or under a certain scenario, earnings will rise and the EVE will drop. Are we happy with that? Is that scenario a likely one, or is it an unlikely one? Do we need to make any changes to the structure of the balance sheet? For example, more fixed rate lending and less floating rate, or vice versa? We'll need that data, and we'll need to run the scenario analysis to make those decisions at the ALCO. And I should just add, ALCO needs a seniority and authority to be able to take those decisions and feed them upwards, either to the ExCo, so the ExCo listens to it, or to the board direct. Okay, thank you. Now, break down the semantic barrier in the banking process. So I mentioned strategic ALM, okay, or a proactive approach. This requires us to have a single integrated approach to origination of balance sheet items, both lending and deposit items, okay, which is why what we say on the start of slide 9, okay. Ideally, everyone talks in that same forum. If you look at the third bullet point, we have on the ALCO, the heads of the business units attending, and their thinking, their strategic thinking, their volume setting is integrated with each other. In other words, the type of funding is appropriate to the lending that's being done, and the type of lending that's being done is appropriate or relevant to the funding that's being taken on board. In other words, to make an extreme example, very extreme, we wouldn't be too happy if today or post 2008, a project finance business unit was funded with overnight wholesale deposits. Equally, I probably wouldn't need to issue 3-year medium-term notes to fund my balance sheet if most of my business was trade finance, which has an average maturity of between 90 and 180 days. So I'm using two very extreme examples to make a point, and the point being we have an integrated approach to setting volumes of both lending and deposit taking such that each side of the balance sheet is connected to and appropriate to the other. Okay, and that's essentially what we're trying to achieve with this integrated approach to managing the balance sheet. Okay, thank you. Now, I keep mentioning the role of the ALCO. I've probably, for those of you who know me, I've been saying this for many years now, the most important executive committee in a bank in any jurisdiction, any country in the world, because it owns the balance sheet. It has accountability for ensuring the balance sheet is appropriately structured and therefore long-term robust and viable. How can ALCO overcome these communication barriers, the semantic barriers of communication that we illustrated a few slides ago? First of all, it's given the appropriate authority and responsibility and accountability. It has appropriate seniority in the governance framework of the bank. It is responsible for ensuring the board of directors is aware of the balance sheet structure today, that it's robust, and also is comfortable in understanding the sensitivity of the balance sheet to changes in market factors, unforeseeable market factors that are, of course, outside its control. Central bank base rates are outside the control of a bank's ALCO. The behavior of customers up to a certain point is beyond the control of the board of directors. So changes in external factors beyond the control of the board that can't be foreseen to any great accuracy require long-term robust and viable planning. Balance sheet management. The ALCO owns the balance sheet. It's responsible for providing strategy and direction with respect to balance sheet structure and shape. What does that mean? It has a view of what the optimized balance sheet structure looks like, optimized for those three stakeholders. Go back before 2008, if I'd mentioned to you or I'd had a conversation with the boss about optimizing the balance sheet, that would have meant maximizing return on capital. That's what it meant. We're having a conversation, Moorad, today about balance sheet optimization. What that means is, how could we maximize return on capital? Today, it means meeting the needs of all three stakeholders. Remember the Venn diagram from a few minutes ago. In other words, maximizing return on capital, absolutely, but also ensuring the balance sheet shape and structure meets regulator requirements, and these stipulate minimums of capital and liquidity, and also that it meets the needs of the customers in the bank offering products that the customer actually wants. Okay, so the ALCO has a view on the optimized shape and structure of the balance sheet. It also manages to board approved risk appetite limits. So that's the role of the ALCO. The board approves appetite for risk exposure. It sets in quantitative and qualitative, I suppose, but essentially quantitative risk limits for capital and liquidity and market risk and foreign exchange risk, all balance sheet risk items, and the ALCO manages to that. Now, the third part of slide 10 is possibly more controversial for some, because I'm giving ALCO approval, authority, or an oversight, not necessarily approval, an oversight over areas that weren't traditionally in its remit. But the rationale for me is clear. First of all, credit risk. If I was to ask you, what's the biggest driver of the regulatory capital requirement in your bank? I'm fairly sure 9 out of 10, if not 10 out of 10, will say credit risk. Credit risk exposure is the biggest driver of regulatory capital requirement in just about every bank in the world. And yet, traditionally, it's not been under the purview or the oversight of the committee that owns the balance sheet. So an element of oversight over the policy. I don't mean approving individual credit items or extending a corporate customer's overdraft. I mean, what's the policy on credit risk exposure at this bank? ALCO must have oversight of that because they're the ones who are managing the balance sheet. Traditional areas of responsibility are there and are not controversial, managing the bank's liquid asset buffer. Today, of course, under Basel, we call it HQLA, high quality liquid assets. But having an element of oversight of a credit policy enables ALCO to genuinely own the whole balance sheet and implement a strategic ALM process. The other bullet point there, approval authority for new products and processes. That's usually in some new product subcommittee. Some people say there's an element of compliance there, so possibly not for ALCO oversight, but of course, what hits the balance sheet more directly than anything, interest rates that you set on your products and the products themselves. So again,
I have an interruption for a question. I do apologize for interrupting you while you were going. I was trying to take the best moment. Someone asked, managing NII sensitivity and EVE risk can be two sides of the same coin. For example, in a hawkish interest rate regime, we see the NII going up, but EVE will drop. How do you manage the seesaw and what is the right balance?
That's a great question, and it's currently the conundrum for every bank in an IRRBB Basel environment. With respect, if I may just address that very quickly right at the end, because it's quite a key topic, okay? So I'll remember that question and I'll come straight back to it if that's okay, Megan. And we can go to the next slide, please. Okay, now, right at the start, I said we've got a challenge in getting the right data, doing the right data analytics, being able to do at quite a granular level, stress testing, scenario analysis, what if scenarios, so ALCO has the right information in terms of current and forward-looking exposure. Communication is everything, particularly at the highest level. The board of directors will not read, well, generally, in my experience, don't read the ALCO pack anyway, but balance sheet information is critical for them to be aware of, particularly the sensitivity. So something that looks like this is a hypothetical bank. There's no such bank in the world as Choudhry Bank, although I'm happy to set one up if anyone wants to forward capital to me. Now, there's no such bank as Choudhry Bank, but that's a hypothetical one-pager of balance sheet metrics. Now, what you put in the middle is specific to the bank in question. What I'm trying to communicate here is have a succinct and accessible comms reporting of balance sheet risk such that the board of directors downwards are familiar with it. They're able to, it's accessible. They're able to read it very quickly and understand sensitivities as well as current exposures. Behind this slide, you might have some forward-looking scenarios as well. But it's very important to have the balance sheet summarized in 1 or 2 slides at the start of any Exco or ALCO or board meeting when you're talking about the balance sheet. Okay, next slide, please. And I'm coming to the end of my slot, but before I do, remember our challenge from the earlier slide, the 3 principles. We have a top-down as well as bottom-up process to manage when we manage the balance sheet. Remember, the board is ultimately the responsible authority for every risk type in the bank. They're responsible for steering the bank, well, ensuring that it's long-term viable, really. I've never come across a bank that had a mission statement to wind itself up after 10 or 20 years. We are but temporary stewards of a balance sheet that ideally is around in perpetuity. So that's the top-down bit. But of course, there is the communications upward, the understanding of sensitivity. That's more bottom-up, okay? Proactive ALM requires both approaches. It requires the deep, granular level stress testing, data analytics, scenario analysis, forward-looking risk exposure. It also requires the board top-down to approve appetite so that ALCO can manage the balance sheet within this approved appetite, and also ensure that the board is aware of these sensitivities. That's why if you think about it, the ALCO's in the middle of it. It's the middle of that bottom-up as well as top-down process. Risk culture also comes from the top-down, and that's where we have the influence on how risk management is undertaken in a bank. What's the risk culture like in a bank? Okay, right. Sorry, forgive me. That's just a FYI on, thank you, Tom. That's just an FYI on an interest rate risk report, but that's just for your reference there. What is this management information telling you? The reason I followed the summary slide with this is exactly just that. Putting this at the board level isn't telling them in the snapshot picture what they want to see. This is actually a regulatory reporting template, compulsory template for every bank in the UK. It's great at the ALCO level, but at the board level, that bottom-up comms we want more obviously succinct and accessible information, okay? That's why I ask, what is this MI telling you? Because we need to be able to know straight away what all the MI is telling us, whether we're at the ALCO or the board. Next slide, please. Okay, I believe this is my last one. Is it, Tom, before I hand over?
Yes, it is.
So, yes, indeed. So, to stay ahead, I would suggest we need to move on to a proactive, a strategic ALM approach, so that at the right level of seniority, everyone at the right level is aware of the sensitivity of the balance sheet, so they don't fall foul of changing market conditions, whether it's Silicon Valley Bank in 2022-23, or whether it's Northern Rock in 2007, or indeed Royal Bank of Scotland and Citibank in 2008. And that's, I hope that the central theme of my talk just now was the role of the ALCO, that communications process, addressing the communication challenge, and also addressing the data analytics challenge. And all of that is an ALCO level conversation. Okay, I'm ready to hand over, sir. Thank you for listening, everybody. Should I just quickly address that question we had? That is exactly the challenge we are faced with. You have identified what is the original challenge from the Basel paper, BCBS 368 in 2016. We have two metrics that move in opposite directions for most banks in most countries around the world. The vast majority of banks, 99%, I would say, off the top of my head, they move in two opposite directions for the same interest rate scenario. One can't structure the balance sheet for both at the same time. So one has to prioritize earning sensitivity or present value sensitivity. That's basically it. The answer to the question is ALCO will need to prioritize one over the other. Now, if a bank has an equity listed on an exchange, it's fairly evident what the market value of that bank is. You multiply the number of shares at issue with the share price of the bank. Generally, bank values, share prices go up when interest rates go up. Historically, that's always been the case because investors see that as an opportunity for banks to widen their net interest margin. You have a more positively sloping yield curve, interest rates are going up, they're going to make more NII and NIM, therefore the share price goes up. That's the opposite direction of the EVE metric in a rising rate scenario. So ALCO will need to decide which metric it wants to prioritize the bank on while staying within appetite for both metrics at all times. That would be my answer to the question. And with that, thank you for listening, everybody. I will hand over to Dr. Ho. And again, may I just say what an honor it's been to share this stage with him. Thank you, sir.
Thank you, Professor Choudhry. And
we do have one more question that just popped up. How CSRBB helps in risk mitigation when we have NII and EVE in place currently? Will it help in strong risk management practices?
May I take that, Dr. Ho? The first question is, how does it help in risk mitigation? According to the guidance from Basel and the European Banking Authority, it will help in banks understanding the capital impact of a change in the credit quality of their portfolio that is not driven by changes in interest rates. Okay, now the guidance is not very clear. There's an ongoing debate about it. Does one only look at my interpretation is it's only for a bond portfolio. It wouldn't be the customer loan book. But in theory, that's the approach. You were saying the second part of the question has disappeared from my screen. Sorry, the second part was, will it help? I think you believed. I think the question was, will it help better risk management? Well, in theory, yes, it's part of the guidance. If you were to ask me if I was attending your ALCO and the conversation was about CSRBB, I would say we would put in place a measure, a limit and a measure for understanding the credit risk sensitivity of our bond portfolio, whether these are bonds held for liquidity reasons, HQLA portfolio, or for cash management or any other reason. And I would leave the customer loan side of the balance sheet out of it. And I would put in a measurement, a credit spread, per basis point change in credit quality, if you like, measure, and a little appetite around that. And I would proceed on that basis, and I would put that in the ICAP as well. That would be my interpretation of the guidance. Thank you.
Great. Now, thank you very much, Professor Choudhry. I think Professor have a very good overview of the principle. And I would like to continue with this discussion about the implementation. How do we actually proceed to implement this principle? And I believe that we start with the value. And that's pretty much what Professor Choudhry just talked about. is at the end, we still want to know the value. And the value really is the present value of the cash flow. And therefore, we propose that it has to be consistent with the capital market or what the capital market pricing of the instrument of the balance sheet, what's the capital market pricing, the risk premium, and how all this value be embedded inside the financial reporting. So in a way that is really addressed to what the question was asking, as what Professor Choudhry talked about, is how to reconcile the EVE and EAR, because a two-way of approaching it, and it really should tie back to the value. And the value really affect our income, like Professor Choudhry talked about, is that at the end, the value is the present value of the cash flow. So income and value are related, even though they're measured in different ways. And income, therefore, will also be related to the capital markets. It is important to notice that the uncertainty of the capital market is also reflected in the capital markets. And therefore, we can actually infer back the probabilities assigned to the scenario that the income simulation is talking about. And that's what Professor Choudhry talked about, is that to reconcile the EVE and EAR, we look at scenarios. But we can do more than that. We can actually assign probabilities to truly understand 100 basis point up in rate. What kind of probability are we talking about? And consequently, the ALCO can decide the risk and return trade-off. Given the foundation of the value and income, calibrated the market, as well as tie back the value to earnings. Now, ALCO can take control. Now, recall the page that Professor Choudhry showed is how all the numbers put together for one page for ALCO to understand. But behind each number is a risk report. And all these risk report, EVE, EAR, repricing, liquidity gap, and many others, should be consistent. Otherwise, it is not really actionable. Because for a bank, we cannot take actions based on a number and a high level. We can drill down to all the reports that it makes sense. But that's not all. The last slide that Professor Choudhry talks about is the senior management looking at entire balance sheet, as Professor Choudhry talked about, including the credit risk should be in ALCO. So now holistically, senior people look at them. But that is not the point. The point is whether senior management can take that information to make decisions. It is a top-down management that is consistent with the bottom-up approach that Professor Choudhry talks about. Now, what are we proposing? We're proposing a very simple idea that is income risk. To us, income and risk are inseparable. Yes, they're two different entities, two different perspectives. But in fact, they're not. After all, they're cash flow. They should be combined to understand what the risks are embedded inside the income. Just to bear that in mind that income and risk is inseparable, one of the same. Now, you can see that ALCO has been around. Asset-Liability has been around for many years. So fixing the wheel while it's turning is difficult. Is it really? Look at this carriage. Is the carriage okay when it's not engineered correctly? Is it okay that the wheels are not aligned? Is it okay for the driver? Is it looking at the different direction? Is it something that we don't have to fix? But of course, we're not here talking about fixing carriages. We're talking about banking. So let me use Silicon Valley Bank, using public information. And like Professor Choudhry says, that let me quantify all the reports and what they really mean, instead of just talking vaguely about what really drove Silicon Valley to failure. So Professor Choudhry, as well as the question, was asking how EVE and YE are the two reports. And Professor Choudhry said probably 90% of them have this following picture, just like Silicon Valley Bank. Look at this. The base case is here, 300 basis point up. The value comes down by $7 billion. But on the right-hand side, when value goes up 300 basis point, the NII goes up by 50%. Now, this is almost like a gauge on the dashboard saying that you turn right and you also turn left. Is it really that simple to reconcile them? That is because, back to my point, if the model is consistent in value and income, they should not be arguing between them. It should be consistent. There is a reason behind that, why they're different and how you resolve it. Now, let me look at other reports. Are the wheels really aligned? Now, Professor Choudhry says that in ALCO meetings, we should have all the numbers and then we can make decisions. But let us look at where the numbers come from. These are the reports. I just picked one, liquidity gap report. What it says is that how much of the principal go out and how much of the principal come down. And they're supposed to be relatively matched so that your balance sheet is not stressed to continually searching for funding what is going out. And look at Silicon Valley Bank. Right from start, more money goes out than coming in. And it continues. The cumulative gap continues till 10 years. They're pushing all the payments all the way far out. And that is the risk. That is the risk. So this report, along with other reports, cannot be giving ALCO a coherent narrative about what is the bank performance, how is the bank making money, and what the risks are. So to the question that earlier came, is risk management important and dealing with EV-ER? Yes, but it's not just two reports, a whole set of reports that ALCO is looking at. Do they come up with a story, a narrative to talk about the bank? How you go forward. Remember, this is forward-looking. This is what Professor Choudhry keeps emphasizing. We are talking about forward-looking. This is the gap report going forward, showing that this is all not consistent with other reports. There is no coherent way of talking about the bank. But then you argue that maybe a driver is looking at different directions. This is not what they're looking at. What is the driver looking at? Earnings. Professor Choudhry said that too. He said at the end, you have to make a decision what you want to look at. Well, I choose to look at earnings, net interest income. This is Q4, 3 months before its collapse. The bank is reporting 3.777 billions of net interest income. And how did they do that? Well, balance sheet is $209 billion, and they're holding only 74 billion loans. How can so little bit of loans volume can support such a large net interest income? That's the question ALCO should be asking. It doesn't matter which perspective you're looking at, EVE, EAR, earnings, and so on. They should be consistent because after all, the entire balance sheet is just cash flow. Therefore, we should find out why. But it's not that difficult. I'm using public information. What I do is I look at the perspective from the senior management perspective. It's not bottom up, as Professor Choudhry talked about, looking at the lending, looking at the funding, looking at all the analytics. No, it's top down. I'm looking at net interest income projecting out 5 years. This is the blue line. And when you see the blue bar, that is the product profitability, including the funding. If you look at the asset, how much they're making, along with the funding, that's the blue part. Just by way of comparison, I compare with New York Community Bank Corp, and also in the news this year, in the first quarter, and you can see both banks have significant profit in Q4. Then come to Q1, then come to Q2. Both banks increased their balance sheet significantly in these 2 quarters. But you can see from the SVB case, the profit from the products becomes smaller and smaller and make up by risk. Such is not the case with SYCB, because they do not have the interest rate risk. It's in the news because of credit risk. What's the most dramatic is the 2 quarters before the collapse. Look at this picture. Now you can see that much of it is just red. The profit is already gone. By the time you go to Q4, 3 months before the collapse, basically there's no profit. Everything is driven by risk. Such is, again, not the case with MICB. They significantly offering profitability going forward for 5 years. I often hear that this analysis doesn't apply to most banks because Silicon Valley Bank is an isolated case. None of their banks have depositors like SVB. Is it really? Republic First Bank, $6 billion bank, less than 2 weeks ago failed. And by all accounts, Republic First Bank is a regional bank with branches across several states. Nothing special about them, except for performance, of course. Now, you look at the NII again. What the driver looking at, what senior management concerned about financial reporting, this is the NII projecting out 5 years. You notice the theme remains that the blue part, the profitability, is small. It is all driven by risk, attaining this NII that they're reporting. And this is Q4, again, 4 months before its collapse. The NII drops down significantly, and more so is the profitability of the product along with the funding is small. Now, don't be distracted by the size of the blue color, because if you do the calculation, they're only making 50 basis points on this product. And then it keeps shrinking. Why? Because they put a lot of investment, long-term investment at the end. So after a while, the product profitability is shrinking. Basically, this picture shows that this bank balance sheet, the business model, cannot support all the expenses and so on. So what have we learned from this? What we have learned, following the principle of banking as Professor Choudhry talked about, is that first, dismissing quantification. It fails to really measure the value and the income together, a consistent fashion, so that there should be really no difference or can be reconciled between EVE and income. And now we can do this along with the stress test that Professor Choudhry talked about. You can also look at different scenarios, but those scenarios also driven by consistency with the market. The market actually can provide you the probabilities of the scenario that you're testing. So therefore, by arbitrarily set a set of scenarios, by arbitrarily the set of all the refinancing, funding, and so on, it really masks the underlying issues of the balance sheet. But if the model is totally consistent, then you can drill down to a clear narrative about your success. Therefore, the ALCO report is not a checkbox for you to check off whether all the numbers are correct. It's the underlying narrative of how the ALCO understand the performance, what drive the risk, what drive the earnings. And that is that report summarized in these numbers. Semantics. Because now all the numbers are consistent, and therefore the market risk, credit risk, and the performance are all integrated. And therefore, like Professor Choudhry said, is that now communication is important, because now we have a way to communicate across different multidisciplinary units, and by standardizing the measures, and now we can have an actual communication. And also that's what Professor Choudhry first slide talked about, communication. But it's really hard to have communication where you don't have a standardized measure of risk and performance across different units. And that is what I'm talking about. And implementation, we need to understand how to quantify, how to communicate across. But of course, communication is only the means to an end. What's the end? Decision making. By communicating bottom up to top down, now we have a communication. Now we can make decisions that are totally effective and clear narrative about the bank. How difficult is it, from what I've shown quantitatively across different risks of Silicon Valley Bank? How complicated this is for the top down and bottom up to communicate and discuss why the performance of the bank is like this. It fails because it's siloed. That is exactly what Professor Choudhry said. By being siloed every part, they don't communicate. You don't have a clear narrative of what the bank is really doing. Wow, Tom. It sounds like a lot of things that we have to change. Not at all. All we're saying is connectivity. You're already doing the EVE, EAR, gap report, liquidity report. You have all the reports, but they don't communicate. As I just showed, liquidity gap report saying one thing, EVU report saying one thing, EAR report one thing, and it's up to the board to decide which report they want to show. How can that be possible? Now, after you make sure all the reports are consistent, have a clear narrative of the bank is what really doing, then you trust the model. Why? The model is consistent with all the market pricing in the capital market. That's a reality. And there's a second reality. The second reality is the financial reporting. What we are saying is that if your model is consistent with capital market, where you do your origination, loan origination, where you do your funding, is consistent, and then all the numbers consistent with the financial reporting, then you can make decisions about which part of the balance sheet you want to change. Once again, that's measurement. What's the end? The end is decision making. Decision making is that when you look at income that the senior people are looking at, the senior people should also have the analytics of the income. That is, the NII can also have a sensitivity to interest rate change, sensitivity to your gaps, sensitivity to your credit. There is all this sensitivity analysis should also apply to the NII of financial reporting numbers.
Tom, we have a question.
Sure.
Given the sometimes opposite signs of EVE and NII, how do you consider the ECB's new requirement that European banks have to stick to supervisory outlier test, which require IRRBB to be less than 15% of Tier 1 based on EVE and 5% of Tier 1 based on NII over 1 year?
Yeah.
Should I take that, Dr. Ho, or would
Yes,
you like
please.
to? Sure. Okay. Thanks for that very good question. Okay, my view on this is that the ECB has recognized what the two of us have just been talking about here about the opposing directions of this, and they've wanted therefore included, because previously the Basel guidance, which EBA adopted verbatim, was a metric, an appetite just for EVE sensitivity, recognizing that earnings are obviously a big part of the whole puzzle here, and that it in practice there's more emphasis on that, whether right or wrong, than the EV metric. My surmise is they've recognized that, and therefore they've put a limit around that. So boards can stipulate an appetite of earning sensitivity and structure their balance sheets to meet that. That in theory is a good thing. But of course, in practice, we now have, in the Eurozone at least, we have two metrics that have a hard stop limit from the regulator, 15% of tier 1 for EVE and 5% for the earnings, which is a non-static, it's a 12-month view or a 12 to 36-month view. And we've now got to manage to both. So we'll have to manage to structure the balance sheet so we're within those two limits. Again, that's an ALCO conversation to decide which one you're going to, inverted commas, prioritize, and which ones you're going to Dr. Ho's point, to assess from a consistent viewpoint. It doesn't, to me, actually necessarily make the challenge and the decision making any easier. But I think the ECB is recognizing that, practically speaking, most banks do operate or structure to an earning sensitivity. So putting a limit for sensitivity makes sense. So I can understand that logic and I agree with it. But it doesn't necessarily make the decision any easier when deciding how exactly to structure the balance sheet. I did like, may I just say, what Tom just said earlier about ultimately it's not just the comms, that's a means to an end. It's about taking a decision. So either way, the ALCO still got to decide how they want to approach structuring the balance sheet, now from the point of view of the limit on these two metrics. I should just emphasize, of course, that's, as far as I'm aware, that's in the Eurozone only. It's an ECB requirement. Thank you.
Yes. So I will be brief. I will be addressing that question too. It's because what we talk about seems to be a very significant change, but it's not. We are proposing that it can be done in a margin. You can look at each strategy, just like Professor Choudhry just talked about, is that when you make a decision, could be just a commitment of loans, funding a loan, and so on, it can actually go through this whole process to make sure that your loan that you're doing are with the appropriate funding, how that will flow to the financial reporting. Everything will still be consistent, and how that then augment the balance sheet attribution. So therefore, the proposal we're talking about doesn't have to be applying the entire balance sheet, but it can be portion of the balance sheet, can be even a loan origination. So in summary, what Professor Choudhry talked about is that the banking is a process. It's a process that you have a transaction part that interface with the capital markets, and then you have the ALCO that bringing all the reports together in one coherent way so that we can talk about the risk analysis and so on. And then we bring all the way to the analytics, to the senior management level, and now you can make a top-down decision all the way down. So now you have a consistent framework of managing together. Now, going back to my earlier discussion, that ALCO has been around and Asset-Liability has been around. So to the question we just asked is that there are other constraints put on. How do we do that? What we are talking about here is a structural part of the balance sheet. How the balance sheet should structured and modeled correctly. And now you can also add on top all the other, what Professor Choudhry talked about is the risk appetite statement, RAS, or management action trigger. All those can put on top and see how close you are to each of them. And this is the model framework that allow you to now deal with the internal part of all the other nuances of the bank. But the reverse will be very difficult. If we ask how to deal with this particular requirement, how to deal with that particular requirement, then we can't put them together in a coherent way. And we're back to the problems that we're facing with all the banks, right? So they are interrelated. At the end of the day, the entire balance sheet is just cash flow of each instrument, facing the same risk, facing the same part. So we have to focus on the structurally correct, and then we adjust it, add on to it how your performance measured, how bonuses are given out, how the regulators require certain ratios, and so on. That can be fixed, but it's not the way around. So in conclusion, what are we talking about? We are talking about the proactive balance sheet management. What is it? We are just saying that arrive to the structural balance sheet position by design rather by well-intended accident. And that is what I'm talking about. Design the structure that's a robust first. Go to very basic about at the end is all about balance sheet, about cash flow, and how they all tie back together. And therefore, the income attribution always says it bringing the income and risk in one paradigm. There's not risk and income separated. As we began our discussion today, that EVE are supposed to be different. They're not. They're one of the same. It really depends how you look at it, how you make decisions with it. Second part is consistency. In order to communicate across all the business units, risk unit, and so on, we have to some quantification that's consistent across that we can make decisions. How can ALCO look at all the check boxes and decide what to do? It's not saying anything because risk cannot be summarized by one number. They're all interrelated. So we need a model that ties them all together so that you push one button, the other button goes up. You're not supposed to have two gauges telling you to go right and go left at the same time. Better communication. The purpose of all communication is to make decisions. I think Professor Choudhry put it very well. In the absence of head of the lending sitting next to the head of deposits, we have a better way of communicating in the entire bank, not on the front desk, but from top management to the bottom-up management. So I conclude with a final slide that how Professor Choudhry started. I think Professor Choudhry is very generous about his Venn diagram. In reality, our bank is subject to all these constraints that we talk about. The sweet spot is tiny. In today's environment, this is a sweet spot we're talking about. Professor Choudhry's picture has a very large sweet spot. In my experience, sweet spot very tight. Just like the question we just got. Regulators have another ratio. That regulator has another ratio. They're getting smaller and smaller. So how do you do that? Follow our principle. Our principle says that if you have a consistent model, clear narrative about what your bank is doing, then you know how to adjust each of the moving parts to hit the sweet spot. So I'm at the top of the hour now. I'll leave 2 minutes for questions. Thank you very much. Megan, are there any questions?
As of right now, there are no open questions, but everybody can feel free to answer oh, we got one. A basic question with regards to capital requirements. Does ALCO look at the numbers based on economic capital or regulatory capital calculation as prescribed by regulators?
May I take that,
Yes.
Dr. Ho? Yeah, I mean, you have a choice. I would always say regulatory capital. Why? Because you are obliged to follow it. So whether you're assessing attribution of P&L or return on capital or anything else, ultimately the reg cap is the minimum. So that would be my denominator. That's just my personal view. It's an ALCO conversation yet again, and your ALCO will decide. But I would suggest the EC value is lessened in a post-Basel III environment because we've got much higher reg cap minimums and we've all got to meet them. So let's do all the analysis based on reg cap. Just a personal view.
We have 1 minute left. Or any questions?
Should equity be included as part of IRRBB exposure as equity capital is being used to fund assets?
You know, we need a whole separate webinar to answer that. One, in theory, the equity is part of the total liability structure, so of course it's funding part of the balance sheet. But in the orthodox corporate finance 101 approach, equity is invested in risk-free, as it needs to be there to absorb unexpected losses. So I shouldn't use it to fund credit risky assets. But we need a whole host of other time to answer why I think that is the case. I've just seen another question from Carlos Forth about there. It's top down. Dr. Ho will by the way, may I just say I loved I loved everything you said, Tom. I'm mad for it. But it's an ALCO conversation. The culture comes from the top down. If you have a chair and a CEO and a CFO and a C-suite that understands and recognizes of managing balance sheet and the ALM discipline and being proactive about it, then the treasurer will be convinced, because ALCO is going to, well, convince them. If you don't have that culture, it's much harder to make them change that approach. Okay, and that would be my answer to that question. And I just want to say as well, Megan, I feel like a bass guitarist that's just walked out of a recording studio having played on a Paul McCartney album. This is just fantastic. I've really enjoyed myself. I love this, Tom. Thank you very much for the opportunity. It's a real honor for me. Thank you.
Well, we still have one more question. Any suggestions on how to convince treasurers to move in that direction instead of treating balance sheet as the old trading books approach?
That was just my previous thing about ALCO having to have the right culture, and that comes from the top down.
Okay, perfect. And then we had somebody say that they just wanted to thank you both for all the informative information. And
You're very welcome. My pleasure.
a shout out from Benny that says, thank you, Moorad and Tom, as always. The importance of accurate integrated analytic, which conveys clear communication to the decision makers, cannot be underestimated. Hi, Moorad. Hope you can keep on playing your bass.
No, it's a long time ago now. That's a relic. But thank you for the very kind words, everybody. I appreciate it. It's been my real pleasure.
Great. Thank you so much. Thank you. Oh, there's one more.
It was just, this has been great.
Oh, okay.
Thank you for very kind words. Really appreciate it. Tom, I'll never forget this. At your service, anytime you want to do this again, I'm there for you. Okay?
Well, thank you very much, Professor Moorad. And thank you, Megan, for hosting the meeting. I think
thank you, Megan. And thank you,
No
everyone.
problem.
Thank you.
Thanks
just
for your
for
company.
everybody's information here, this has been recorded, and I will be sending out a follow-up email to everybody, because I know I got a lot of emails today that said that they couldn't make it and wanted that recording. So I will be getting you all that information. And yes, the slides will be shared, including the recording.
Great. Okay.
Thank you, everyone.
Thank you.
Have a good afternoon. Take care.
Bye-bye.
Bye-bye.
Bye.